Welcome back to FinTalk, brought to you by VERMEG. Here we discuss pressing topics in fintech, regtech, covering regulatory, collateral and digital across banking and insurance and finance. VERMEG has been proud to deliver innovative software solutions in the industry with stability and cost efficiency for a global roster of clients. With over 20 years of trusted transformation in finance and insurance, we're bringing industry's top expertise to FinTalk. I'm Gerald Akhtar and I'll be your host for this podcast. I'm thrilled to share with you the latest award of Innovation in Digital Custody 2022 from Global Custodian. VERMEG is enhancing its Megara's position into a crypto ecosystem. This is another great milestone in this rich year. We are looking forward to more achievements and more awards. With this in mind, I'm delighted to have with us Barney. I'll let Barney introduce himself and a few words about what he does.
Hi, Howard. Thank you for having me. I'm Barney Reynolds. I'm a partner in the international law firm Shearman Sterling, where I'm head of financial institutions and also head of the financial regulatory group. I specialise in financial regulation, UK and EU in particular, but also manage a team across the world. And one of my key interests is in crypto and digital assets.
Fantastic, Barney. I know how busy you are, so I appreciate your time being on this call with me. Thank you.
A pleasure.
So I want to talk about crypto. I know there's been a lot of talk in the market, especially with the government announcing their kind of roadmap about what they want to do. So in your eyes, where is crypto regulation in your trade? Is it the top, middle, etc., or actually on your desk already?
It's pretty significant. I mean, I'm helping clients around the world in the current context of the law and regulatory frameworks that exist, which are pretty light touch. They're light touch in emerging financial markets, and they're almost non-existent in the main ones, in as much as in the major markets, you look to apply the existing concepts and definitions of what's regulated, but there's not that much that's specific to crypto. So that's the sort of world I'm operating in, or we're all operating in at the moment. And I'm helping people in that environment where people are essentially dividing their businesses in two at a macro level between the US and rest of the world. Rest of the world being serviced from offshore centers, principally outside, obviously, the US, and to some extent, sort of more peripheral onshore locations. But I mean, things are changing, and I'm sure, rightly, this is going to be an area which is much more regulated, and so it'll be pulled gradually onshore, and my sort of life and work will change, and it'll become more normalized, as it were, in the context of the sort of financial business that I advise on.
Yeah, it definitely feels like it's moving at some pace. So when do digital assets have a formal role in the mainstream institutional or retail economies? Or have they, already arrived?
They've not arrived. They are operating largely, as I mentioned, outside the scope of the regulatory regimes around the world. There are some very exciting innovations happening, all sorts of potentially very useful digital assets being developed and created. The question is, how can this fit in with the general financial architecture of the world, within the financial markets, with the financial institutions? At the moment, those points have not been decided. So what we have is some cryptocurrencies that are traded on exchanges, but they're not exchanges in the regulated sense that someone's properly overseeing them to make sure that there's a clear and fair market. There's, no downtime, or if there is, it's very limited, and so on. We have wallet providers, which generally are often not regulated as custodians. We have people, trading in and making vast profits, or as of recently, losses potentially out of these cryptocurrencies. Then you have stable coins, which are more pegged to a fiat currency, depending on how they're set up. Those are ones you asked about the UK earlier, and the financial system. I mean, those ones are being stitched into the financial architecture perhaps first out of the things I've mentioned, because they're going to be, systemic stable coins are going to be regulated under the payment system regulations. CPMI IOSCO, the global body, made a recommendation to that effect. In the UK, the Treasury have announced, John Glenn, the City Minister, announced that would happen. That's a big step forward. That will integrate stable coins to some degree into the system. And then finally, you have digital assets like non-fungible tokens in the financial context. Some of them, many of them can be non-financial. Those all need stitching in as well. in terms of rules for how they have to be offered to people, what sort of representations are made about them or need to be made about them, and where they can be traded and on what sort of market and how and by whom and so on, for which there's a lot of technology in global law and regulation that people have thought about and worked on for decades that can be morphed and applied to these new things. But things need to be thought about afresh so that we're able to integrate these exciting new asset classes. Not all of them will turn out to be as successful. Not all of them will turn out to be desirable, I'm sure. But there are amongst these certainly very exciting and useful ones, and they need integrating into the financial system, but in a way that's credible and safe. And I think the regulators to watch here are the UK regulators, because they have, for a long time been thought leaders in parsing through the various risks that one needs to manage in integrating assets into the financial markets, and in doing so in a predictable and frankly safe way.
Yeah, I hear that. And I'm just kind of keen to understand, where are we in terms of treating digital assets unambiguously as capital, collateral, or even legitimate liquid assets on a financial institution's book?
We haven't developed rules or thinking around that yet. I mean, the regulators and the UK Treasury are looking at crypto and digital assets, and there have been some interesting speeches given by people at the Bank of England and papers prepared and so on. But we don't have a worked out regime around that. I mean, part of the reason is some of the asset classes have been developing so quickly, it's necessary for the lawmakers and regulators to wait and see how things shake out before writing the rules, because otherwise they can be out of date as soon as they're published. But I think we're reaching that point, and I think a lot of it's clearly a lot of deep thinking is going on. And the topics you raise, capital, collateral, and liquidity are central, and the authorities will need to work out, what capital charges are attracted by, some of these assets. Can you use them? And if so, to what percentage value as collateral? And when are they genuinely liquid? And I think on the liquidity front, that may be one of the easier ones, at least in the first instance, because I think the starting point will be the behavior and the historical performance on some of these exchanges. Although even then, because they're so new, you take cryptocurrencies and those are things that don't have any value at all in the real world, that they only have a value in the market that they're traded on. Is it possible that you could have a complete seizing up of a particular market on a cryptocurrency? That sort of thing needs to be thought about as well. In cryptocurrencies, in a way, some of the harder ones you mentioned at the outset, but I think they're some of the harder ones to fix, whereas the digital asset classes that are linked to and really are tokenized representations of, or are real assets. That's the safest one of all, I suppose. Real financial assets that are tradable, then become digital and are traded across, using DLT or other new technologies. Those ones are perhaps the most similar to what we've got, and where it's going to be easier to morph the rules. Cryptocurrencies and other asset classes where it's an entirely crypto concept, there's nothing underlying it as such, are going to be the trickiest ones. And then even in the case of stablecoins, Tether, the largest stablecoin, recently failed to maintain a link to the US dollar, which is a big development. So even stablecoins need to be handled carefully. Bitcoin price last week went below $30,000. These are quite volatile, some of these assets, and that needs to be understood. And I think inevitably will mean that regulation is somewhat cautious in the short to medium term until facts become apparent about how they behave and people understand better how they behave and why.
Yeah, I hear that. And what was really interesting that you raised there is about the look backs. If you're trying to work out the historical performance of some of these cryptos, yet they don't have anything. They're pretty new, right? And obviously the volatility is so key. You're seeing in the news recently about Bitcoin dropping. And you're right, in terms of the digital assets side of it, where MiFID II securities, we're seeing a lot of being traded. So just kind of going on to that, in terms of the digital assets, how do you see them being represented in client systems and so present themselves to be to reporting and MI systems for accounting purposes? Is that something you can touch upon?
Well, again, those are not settled points. So there need to be accepted market treatments of some of these things, and then there need to be accepted regulatory and legal treatments. And this is all evolving real time. I think one needs to break down the different types of products within the asset class, things that are effectively, as you say, MiFID, i.e. regulated financial instruments that are in digital form are going to perform, one would expect, in the same way as the traditional instrument. The only question is, does the technology bring with it a new risk that then needs to be catered for in terms of capital liquidity or collateral treatments, and how do you account for them, and how do you measure do you need a new way of verifying mark to market? But I would imagine, assuming the technology works, things happen as they're supposed to, it does what it says on the tin, as it were, then I would imagine those are going to be most easily integrated into the financial system. And then you gradually move away from those tried and tested products, which are the creation of companies, often, issuing equity or debt, or a derivative being a sort of exposure of a large institution that's got a balance sheet that you can verify that's standing behind it. And you move to things where it's not that, then, and I think cryptocurrencies are at the other end of the spectrum to a degree. How do you value those? Do you mark to market on a real-time basis? If you're dealing with someone that's holding cryptocurrency, you're probably going to want to know how much they've got and of what. And maybe you yourself then would verify how much it's worth at the moment, or what the spot price is on an exchange. Or maybe they should be marking the assets all the time. Because I think there's going to have to be a new sort of science about this. So my general thinking is that these do need to be stitched into the legal and regulatory architecture of the world. There are going to be some that are rejected. Like at the moment, the UK is not allowing retail customers to be marketed to for crypto, basically, and retail derivatives on crypto are not allowed to. You can't sell to retail derivatives on crypto. So that's a cautious approach. I think we're going to end up with something more nuanced, where some of these assets are going to be seen as sufficiently safe for retail because they're the same, more or less, to something tried and tested for which you've got trading history. Some of these assets are not going to be right now, but then gradually can be allowed into the system as more data becomes available in analysis. And some of them potentially never will be allowed for retail. And that's retail. And then wholesale, which is more caveat emptor as a general proposition as a market. Even then, there are systemic risk issues, which don't arise at the moment. The FPC and so on have looked at, the Financial Policy Committee and the Bank of England and so on have looked the current status of the nexus between crypto and our financial stability and so on, and have not found anything too troubling. But that could easily change as these become more and more used by major financial institutions or major clients of financial institutions. And so the interconnectivities all need to be understood. If these assets suddenly go down in value, where does that leave the balance sheets of some of the major trading counterparties in the world? And therefore, should there be restrictions on how much people can hold, or if they want to operate in certain markets because of the extreme volatility of some of these assets? Those are the sorts of things, and many others that regulators and legislators are going to be thinking about. But I don't think it's an impossible task to stitch some of this in the short term and then gradually to expand. I think it would be a mistake to throw one's hands up and say it's all too difficult, just shut it all down or keep it all out or let it be in the shadow economy. Because increasingly, this is not shadow activity, it's coming into the mainstream. People are trading these assets, whether the regulators and legislators might like it or not. And so the system needs to make up its mind about how to treat them. And I think shutting them out completely isn't necessarily a safe thing for the financial system either, longer term. It'll just push it into places beyond the reach of regulation without oversight, where the interconnectivity is going to be harder to spot, but potentially much more dangerous.
Yeah, that's quite interesting, because I want to, as much as we want to kind of try and say take it out of the market or kind of de-scope it or anything like that, this is real. This is happening. So yeah, whether we like it or not, this is going to mainstream. It's making a really, really good point about that. I want to move on to regulation and reporting. We do quite a lot of kind of given these rapid changes regarding the regulations. What is your likelihood that legal perspective responses around how to solve these emerging problems? Because they are going to be quite critical, and they are becoming problems. So, from a legal perspective, what's your standpoint?
Well, I mean, obviously, the world in terms of law and regulation is divided into the common law countries, basically the Commonwealth in the US, and then the civil, the code-based civil law countries, which are the rest largely. I mean, there's a sort of small category of hybrids, but Scotland being one of them, South Africa. But basically, it's the common law on one hand, and then code-based civil law systems based on the French and German code-based methods, including the whole EU on the other. In the common law environment, which is predominant by far in the financial markets, the approach is based on public disclosures, reporting, transparency to the regulators and to the market, real time, where the market discipline comes in to ensure things, counterparty exposures are managed because of visibility of how strong the balance sheet of those counterparties actually is. And in this approach is dominant not just in London, but in New York, the other global financial center, but in Singapore and Hong Kong, also common law countries and so around the world. So under that approach, I think reporting is absolutely fundamental, to the regulators effectively and to the market as a whole. Then the question is, are there exceptions where you don't report? I mean, is a cryptocurrency more akin to a currency or a financial investment? Those are big judgment calls to be. That's a big judgment call to be made in relation to a number of these instruments. So what's in your reporting regime and why? That will be, there'll be all sorts of very difficult judgment calls to be made around the edges. Going back to, we talked about financial products, the MiFID products and so on. I mean, those ones, I don't see why the reporting regime should apply differently to a digital asset from how it applies to any of the assets at the moment. And I think reporting will become more and more important because the digitization of products is likely to lead to more liquidity, more trading, and therefore even more reliance on information. So the more transparent the markets can be, the more the regulators can see where the risks are building up and understand why, the better. But I think it's a central feature of our entire regulatory and legal philosophy, which has stood the world in good stead for, a long time. And it wasn't reported. I mean, the financial crisis was caused by a lack of information around systemic risk, in fact. And so reporting on systemic risk, things that cause systemic risk, which definitely includes crypto, definitely includes cryptocurrencies, definitely includes digital assets, is pretty important. So I think the traditional way of looking at reporting is important, but looking at reporting in the context of systemic risk is even more important. And, subprime debt, which was the cause of the financial crisis in 2007-8 in America, it originated in America, it wasn't transparent where that debt was ending up. And it's not totally different from some of the digital assets being created now, breaking up sort of obligations into tiny parts and allowing people to trade them around the world. And if we have reporting on that to the regulators and to the market as to where those liabilities are ending up, and the market's able to form a view of where they're worth and who's exposed to them and whether they're robust counterparties and so on, then market discipline, I do think, can work its magic in a way that no regulator on its own or group of human beings on their own can do. The market as a whole can basically root out bad practices and bad risk by not trading with people who are running too much risk. And so I think reporting is fundamental to all of this. And I think the lessons from 2007, 2008, insofar as anyone might think it's sort of, that there was something wrong with the market, I think the main thing was wrong, in fact, was a lack of reporting of systemic risk and where that risk resided. And crypto and digital assets are the next frontier where potentially that sort of risk is going to arise again, but in a novel form. And reporting is going to be fundamental to making sure that the markets can operate efficiently, not just in a global center like the UK or US, but around the world. I think it's in everyone's interest globally that where this risk ends up lying and residing is transparent. And then maybe, in fact, the way to think about this is people who don't opt into the necessary transparency disciplines may not be able to access the market so readily because other people will have to assume the worst about the books that they're running.
Yeah, that's really interesting. I just want to end on the last two questions from me, Barney. I think it's quite interesting that you've laid out in terms of the digital assets, crypto, and the reporting side of it. It's how do you, Barney, think regulators are actually likely to respond? And will there be anything that stands out from the UK response as an outlier or indeed actually as a leader? And if so, if you had a crystal ball, potential data timelines for all this. I know technology firms like ourselves are working hard and long to get to kind of adapt to this market, and we have our toolkits in place. But I'm kind of interested to hear your kind of response on that.
Well, I would imagine the UK will produce rules within a year or two. I mean, led by by the regulators, the FCA in particular, but also the Treasury, because some of the rules are bumping up against inherited EU legislation, some of them which are currently in primary legislative text, and they're going to be hived down or devolved to the regulators so the regulators can tweak those rules or rewrite them. That's not happened yet, so the Treasury will inevitably be involved. Also, though, the Treasury will be involved because the definitions of what's regulated in the regulated activities order are in statutory instruments, which again have to go through Parliament to be changed. So there's no one single authority that's going to make this all happen quickly. But I believe the Treasury and the FCA are looking at it hard. And I would guess a year or two to sort of see meaty text, but it may be quicker than that. But even then, there'll be an implementation timeline around it. I do think the UK is the place to watch on the regulation and legal environment for crypto and digital assets. Why? Because we have one of the two global centers, financial centers, the others being New York. The US market has a much more complicated regulatory system in terms of the multiple regulators that are involved there, which sort of a more fragmented regulatory system with different, the states, each of the states are also involved. So, it's a more fragmented system, more people trying to get in on the same problem. And I just think it's going to be slower moving and more complicated, and it'll take a while for that system to bed itself down. The UK can move more quickly. We also don't have punitive damages and penal fines. We deal with losses suffered and compensation for those. So we're a very attractive legal regime with very high quality judges and regulators. And for that reason, we are the market that people seek out for financial business above all others. So I think how the UK then responds to this, which will be, I think, thoughtful and careful and prudent and so on, is being watched already, but will be watched by other regulators and legislators around the world. I think it'll effectively set the template. Lord Turner here was really the architect for an awful lot of the post-financial crisis regulatory changes. I mean, it's taken on by the EU and embellished and all sorts of things added, some of which I agree with, some of which I don't. And I would see it being the same again for this sector. And I think around the world, there are countries, markets, much smaller markets, which have gone out in front and started making rules around crypto. But effectively, I think the real thinking and heavy duty lifting is going to be done here. And so people are going to be watching for it. And it's something that will take time, getting it lined up and thinking through every nuance and drafting it in a clear way that the UK system requires, I think is fiddly, it is fiddly, and we need to allow that process some time. So that's why I'm saying 1 or 2 years, and I may even be underestimating it, but that's what I think it'll be iterative as well. I don't think you'll have a grand unveiling of the whole lot. I think they're starting already. They've announced with systemic stablecoins for underpayments rules. Then they've announced that they're thinking about, what to do in relation to security tokens, i.e., as you say, MiFID instruments, normal investments that are regulated but are in tokenized form. But this is just the beginning. This is potentially almost everything that we know. Almost every legal entitlement is capable of being tokenized or rendered into digital form and traded, which is fantastic in a way. It'll liberalize so many things in the world and unleash huge economic growth. And I think the UK's legal and regulatory system is likely to be at the hub of this because it's so trusted. And ultimately, people will seek out the most trusted system. So it will take time. It requires thought. But I think it'll be worth waiting for. And it'll be iterative. And there may be trial and error on some things as well. But, people will think they've properly defined what a token is or what a cryptocurrency is, but that could change. And partly it'll change because of the market. And the law changes because of the market. I mean, insurance law grew up over the centuries in part through what was going on at Lloyd's of London in the market. Shipping law again over how people would, business people were expecting to deal with each other in relation to shipments. And I think the financial markets are exactly the same. It's partly driven by the innovation that's happening all around us all the time, and then by a different set of smart people looking at that and trying to conceptualize it in a way that doesn't kill off entrepreneurialism and innovation, but manages it and mitigates risk. Managing may be the wrong word, but it mitigates risk and manages risk to some degree and provides for liability systems and recompense where things go wrong and people overreach what they can deliver.
Yeah, that's a really interesting response. I agree with you. I think the UK has been an integral market where I think everyone's eyes are on. Just hearing the Chancellor to say and the papers that have been released and numerous other things that are coming out, and the fact that we're digitizing all our traditional securities. I've seen tech sprints going on, all the regulations that you just mentioned. Technology is starting to be trusted. We're at the forefront of this, so I kind of agree with you in terms of the 1 to 2 years, and we will learn from this. This isn't the big bang. Here it is, guys. And start complying with this. We're going to learn. I think we've learned a lot from the markets that's happened and all the other incidents. We're mature. I think it'll take us slowly. Definitely. But yeah, there's going to be some interesting couple of years ahead. Barney, it's been an absolute pleasure having you on the podcast. Real insight into this market. I know it's exciting times ahead. I know from us, and I'm sure from you, I'm sure you're extremely busy with all these changes that are coming up. And I really do appreciate all your time. Thank you so much.
Pleasure. Thanks, Joe.
Thank you to everyone, and look forward to listening to the next podcast. Thank you.